Can everybody hear me okay? This mic okay? Great. And I'm sure, is that working okay in the back there? Great. Well, listen, I just want to say that it is an honor to be here and speaking to you tonight. I'm really impressed with what this group has accomplished. I have been following and involved in the CIMG for many years. I'm very fortunate to be on the President's Cabinet here at the university and also serve on the Board of Visitors. And to watch the progress that this school has made is just really gives me a great deal of pride and a great deal of satisfaction. And when I see all of you in here with ties on and suits at 6:30 on a Friday night, you know, that is really impressive. I'm not sure my friends and I would have measured up to your standards when I was here. So it's really great to see. I want to talk to you tonight about several things, and I want to try to tie them together. And I guess the overall theme is risk and defining risk, and what is that? And you know, you look at a lot of the things that have happened in our industry over the years, and it's like every decade, you know, there's always something. You know, people are chasing returns. And people take the skills that you are learning now and use them not to minimize risk and preserve capital, but instead greed tends to take over from fear, and people use the skills that you were using erroneously, in my opinion, to pursue greed. And there's nothing wrong with wanting to be successful, but that leads to speculative excesses. And they're just, you know, the examples change, but the stories are always the same. You know, it just repeats itself. You know, in the 80s, you had barbarians at the gate in the LBO stuff. More recently, you have Facebook, you know, $100 billion valuation. I mean, what a joke. It's just ridiculous. You had the internet bubble in the late 90s. You know, every decade has its excesses. And a lot of it is caused by people like me, people like you, who go out and try to make your way in the world. And instead of using the skills that you're being taught to preserve capital, again, it is the emphasis is on return. And what attracted me to value investing, and what I hope is attracting you to value investing, is that it is a noble pursuit. You go back to the original teachings of Graham and Dodd, and it is all about the difference between speculation and investment. Value investors are investors. They are not speculators. And that is one of the very first things that Graham and Dodd were talking about. And they've been followed by many, many wonderful people, people like Phil Fisher, people like Bill Ruane, John Templeton, Warren Buffett. I would include my former partner, Mason Hawkins, who written very eloquently about the difference between investment and speculation. And with value investing, you know, the core concept, what it really revolves around is the margin of safety. And I know as value investors, you've heard about the margin of safety, and you've probably heard different people tell you different things about it. But the idea is that value investing should be first and foremost about reducing risk. And if you reduce risk, then the returns will take care of themselves. And I told you I'm going to try to tie a lot of different disparate things into something hopefully that's coherent. But one of the great things about this program is that you have a marriage between the academic and the real world. And it's so unique. And I am so impressed with what the CIMG has accomplished. I want to particularly recognize Rob Norwood. I want to recognize Coyne. I want to recognize Shane Underwood, and I think I would be very remiss, even though he's not in the room, to recognize Dr. Barry Mason, who was a dean of the business school here, for over 2 decades, and none of this would be here without his leadership. And I'll also mention Charlie Adair, who's been a real champion of this. But what we have is a program that is marrying the academic skill set that you will need, the toolkit, if you will, with real-world experience. And you get to hear people like me. I know Kent did a great job earlier, I heard, and I'm sure that the other speakers did as well. What you kind of have the 80-20 rule. The good news is you have this marriage between academia and the real world, and you can learn how to apply those academic concepts into what you're doing as a practitioner, which will give you a huge leg up when you get out of school and you become a practitioner. But the bad news is it's the 80-20 rule. 80% of what you learn is just simply dangerous. I mean, it is beyond wrong, it's dangerous. But that 20% is a real nugget. And one of the things that you are going to get that I think that is so great, and I would try to ask you to try to keep this in mind as you're going through your studies and trying to connect all these dots, is that you're learning a framework. And that framework is very useful. You can use that framework and take the best from that without getting caught into the traps. And accounting is very important. Financial analysis is very important. You need to understand these things. They're foundational. But then you get into more of the esoteric financial theory. And one of the big things that is both good and bad is that basically when I was in school, the predominant view in academia was it was impossible to pick stocks, that chasing good investments was impossible, therefore don't even try, and instead try to reduce risk. And the part about reducing risk is correct. The other part was wrong. And one of the other things that was wrong is that the way risk was defined. Risk was defined as basically beta. And the idea that something is more risky because its stock price has gone down and therefore its volatility might have increased flies in the face of the core tenets of Graham and Dodd, who would say, assuming a stable value, if the stock price is down, there's less risk in it. So that's a trap. But the framework of understanding and limiting risk first, that makes a lot of sense. And you then get into other things like, okay, great, well, how are we going to find our discount rates? How do we value things? Well, again, CAPM is just dangerous. The idea of starting out with a risk-free rate, that makes a lot of sense. And then having a risk premium, that makes sense. But how do you measure it? Well, you measure, you multiply times beta. And, you have a very sound concept that leads to disastrously bad decisions because the inputs are wrong. The definition of risk is wrong. So let's go back to the margin of safety. I would ask you, what is risk? I mean, if I gave you $1 million and I said, here, this is all you get. This is it. You're done. You'll never earn another penny as long as you live. I'll give you $1 million, but here's the catch: you have to preserve it. How would you measure risk? Does anybody venture a guess? Okay, we'll go, please, yeah. Very good answer. A very good answer. Would you, if I told you that you could have that $1 million return into $10 million over 10 years, but that it would be bumpy along the way? It might go down to 500,000, it might go up to 3 million, and then down to 2 million, but at the end of 10 years, you'd have 10 million. Would you consider that to be an acceptable risk? Okay, very good. So this guy's doing good so far. Watch him. And if I told you that you could lock that money in at 2%, and that there was no way it was going to go down. I mean, it was just, you're locked in over 10 years, 2%. I'm only going to give you 2, and it's not going to turn into very much money, over 10 years. Would that be an acceptable risk? But it's guaranteed. So far, this guy, Alan, get his resume when this thing's over. If you had that theoretical $1 million that potentially could turn into $10 million, or you could preserve your capital and only compound it at 2% a year, well, guess what's happening right now? Today, in corporate America, there's something called LDI, and corporate pension plans, because they want to reduce the volatility in their earnings. There were some rules passed by FASB a few years ago, and basically it said that when the fluctuations in defined benefit pension plans, that it has to feed through the income statement faster than it used to. And that introduces volatility in the earnings. So here we are, equity returns have been basically zero for a decade. Interest rates are at all-time lows. And you know your basic finance, there's a risk premium for stocks because over time stocks have higher returns than bonds. Well, over the last 10 years it's been the opposite. Bonds have had great returns and stocks have had poor returns. So if you believe in central tendency, if you believe in reversion to the mean, what's going to happen? Interest rates have gone. When I was in school, when I started school, it was the early 80s, and Ronald Reagan had just been elected, and interest rates hit 21% on treasuries. Today they're at 2%. I mean, we have been in a 30-year bull market for bonds. Now, is it mathematically possible to have the same returns from bonds when the starting interest rate is at 2%? Well, it's not. And so today, hundreds of billions of dollars are being locked in at 2% because the CFOs who are running these companies do not want to introduce that volatility into their earning streams. And they're foregoing, and think about it, you're a shareholder. We invest in equities. I mean, we don't own those companies. We own the companies who are not doing that. But if you're a shareholder, and you're locking in this liability at 2%, a 2% return, when you could earn a 10% return, but it'd be more volatile over time, think of the wealth that you're transferring from your shareholders. Think of what that's costing you. And all of that is based upon an understanding of accounting and a misunderstanding of applying risk to return. What those CFOs should be focused on is creating wealth for their shareholders. And they are misdefining risk. And it's costing shareholders trillions of dollars in foregone wealth. So, that is just one example of how an academic framework, when used properly, can help you, but when used improperly can lead to disastrous results. So, back to risk. So, very good answer on risk. I would define risk, academia through CAPM defines risk as volatility. It is stock price volatility compared to the volatility of the market as a whole. I agree with you. I mean, if I had to preserve my capital, I could care less. But what is the risk that I'm going to lose money? What is the risk of losing permanent capital? That is risk. And the other risk, and there are a lot of risks, but on this 2% example, what if inflation is higher than 2? What if it's 3? 3% inflation, the long-term inflation rate in this country has averaged 3, forever. So if the odds of inflation being less than 3 over 10 years is pretty low. And if you're only going to earn 2, then you're going to have a negative real rate of return. that is a real risk. Those are the kind of risks you should be thinking about, not how volatile a stock price is or an asset is versus a market index. So we define risk as the risk of losing permanent capital. And the only way to reduce that risk is to have a margin of safety. And the margin of safety is the difference between price and value. The idea is that if you buy something at fair value, you should expect a fair rate of return. But if you buy something at a discount to fair value, you have a shock absorber. We talk in terms of 50-cent dollars and 80-cent dollars. And if you buy something that by any reasonable estimate, using reasonable discount rates, using conservative assumptions, and if any way you slice it, the value is 100. If you pay 150, that thing that you're buying at 100 might be a great investment. It might be a fair rate of return. There's nothing wrong with it. But if you pay too much for it, you introduce risk. Now, the very fact that it's the opposite of a margin of safety. A good investment becomes a speculation when you pay too much for it, i.e. Facebook. Facebook has $3 billion in revenues. It is profitable. I mean, it has a value, but it's not worth $100 billion. The mathematical work that you would have to do for that company to be worth that much money, the assumptions you'd have to use are so crazy that it becomes a speculation. And everybody who bought on the IPO, deservedly got murdered. I'm glad they lost their money. Hopefully maybe they'll learn a lesson and they won't do it again. I mean, but that is an example of an otherwise good business being a terrible investment because people simply paid too much. Now, take the other side of the coin. In the financial crisis, so many good businesses that were just astoundingly discounted. And there are lots of examples, and you could do the math in a lot of different ways. And there you could buy wonderful businesses at large discounts to any reasonable estimate of their value. So you had a big margin of safety. And today it is possible to find individual securities with the same margin of safety. If you buy a business and it is trading at a discount to intrinsic worth, a really wonderful thing happens. You don't get a fair rate of return. You get a better than fair rate of return. It's like buying a bond at a discount. If you buy a bond at par, i.e. fair value, and the coupon is, say, 8%, well, you'll get an 8% rate of return if you hold it to maturity. But if you buy that same bond at, say, 75 cents on the dollar, and you hold it to maturity, depending on the maturity, you'll have a double-digit rate of return. Say it's a 10-year bond. So the larger the discount, the higher the return. But also, the lower the risk. Now, what's the first thing they teach you in Finance 101? Risk and return. If you want higher returns, you have to take higher risk. Wrong. I wanted to use a stronger word, but I'm being recorded. You can generate higher rates of return by taking on less risk if you practice value investing well. You have to execute it. You have to do it. Graham and Dodd, Warren Buffett, Bill Ruane, John Templeton, all these people have passed on, and other practitioners today, to this day, but something about value investors. There's a very generous group of people value investors tend to share their knowledge very freely. You think there's some secret sauce, and you want to keep it all to yourself, but there's no secret sauce. I mean, it's really more mental and psychological than it is mathematical. I mean, the math is pretty easy. Well, it's not easy, but it is straightforward. And with the tools that you are learning in school, you can take those tools, and with enough precision, you can approximately value a number of businesses. And those businesses will deviate from fair value occasionally. And that's all you need. And the way that you do that has been passed down from generation to generation to generation. Your biggest barrier is going to be behavioral. It's going to be psychological. It's going to be, do you have the fortitude to think rationally when others are not? You know, it's easy to look back right now and you know, say, gosh, we were just a bunch of bargains in 2008. Well, you know, most people were bailing out of the market in 2008. Most people were running from the fences. Flows were, you know, huge outflows out of equity mutual funds, and even to this day, if we sit here today, with interest rates at 2%, there continue to be big flows out of equity mutual funds and into bond funds. People are you know, getting out of equities, and when you just kind of do the real basic math, you can find you compare, you know, earnings yields on the S&P 500 to bond yields, and you look at the earnings yield, and it's going to be inflation indexed at least. You'll at least get inflation. So, you know, you're looking at a double-digit kind of return with inflation adjusted growth versus locking in 2% for 10 years. I mean, the math is really easy, and yet most people are taking money out of stocks and putting them into bonds. So your biggest challenge is going to be behavioral. Your biggest challenge is going to be, can I act rationally when those around me are not? And guess what? They'll always tell you that you're irrational. They'll say the market's irrational and just follow the herd. It's 1999 and you should just be piling in internet stocks. It's always at fair value. That's the best estimate of what something's worth is its current trading price. I'll tell you a little anecdote. Back in we had an investment in a company called Catellus. It was a real estate company headquartered in San Francisco. Wonderful business, wonderful company, really well managed. And it was during the dot-com boom era. There was a company called Pets.com that wanted to pay astronomical rents for some old warehouses they had down by the water, not in the nice part of town up in Noma, but down south, not even Soma, it was in Mission Bay. Mission Bay has now become a really big deal. They developed it, it's very nice now. But at the time, it was just a bunch of dilapidated old warehouses. They owned a bunch of them. They redeveloped them into, you know, really nice condos now, but and made a lot of money. But at the time, they just had these dilapidated old warehouses. But it was a cool, trendy area, and Pets.com wanted to be in this cool, trendy area. So they wanted to pay outrageous for buildings that we thought were literally have been torn down. And Catellus would not sign the lease with Pets.com because they were losing money. I mean, they had operating losses. It was just an idea. But the market cap of Pets.com was roughly, I think at the time, and I'm going back, I have to go check my numbers, but it was something like $12 billion, and Catellus' market cap was like $2 billion. But Catellus would not sign a 10-year lease with them because their credit was so bad. So the market, the public market price for an asset is not necessarily fair value. Now, well, Catellus was an absolute home run investment, ended up being bought out by Prologis. It was from that point in time in 1999, if you'd bought Catellus, you would have had fantastic returns, and Pets.com went bankrupt. So that is an example of needing to act rationally instead of just taking what others are doing and saying, well, that's just the best thing to do. And so being a value investor is about being contrarian. It is about having confidence in your own work. And in order to have confidence in your own work, you know, you need to be good at what you do. You have an incredible opportunity to merge the very valuable that you will learn and the framework that you will learn with real-world practicing of value investing through this program. And I am so gratified that you have it. And my hat is off again to the leadership who has done this. Shane Underwood and Rob Norwood, you know, the academic and the student, you know, just fantastic. And I also want to recognize Alan Cox, who's one of my business partners and who's been instrumental in doing this. By the way, I'll tell you a quick story on Alan. I'm embarrassed a little bit. Alan was sitting in a room like this in 2007, and he was part of the university's honors finance class. And they had selected a number of those students to go up and spend a day with Warren Buffett. Alan was one of those students, and they asked me to come in and grill the students because they didn't want them to embarrass themselves in front of Warren Buffett. And just like this guy over here, make sure you get his resume, Alan. Well, you know, we have an internship program. And one of them is here, Will Terry, who's done a fantastic job for us, a really good job. I'm glad to see he's part of this group. But Alan asked a lot of good questions, had a lot of good answers. Long story short, he ended up working for us, and he was there in 2008 when everything was melting down. And he's one of the ones that kept his head about him, and he helped us buy some wonderful businesses when everybody else was panicking. We were buying, and you know, we talked about our record, and you know, thank you for recognizing that. You know, the exact numbers are our large cap composite is in the top 1.5%. Our focus composite is in the top 0.08. Our focus plus is in the top 5. And our small cap is in the top 1.3. We are able to have done, we were able to accomplish that because we were able to keep our heads about us and buy things based upon conservative assumptions, being approximately right, maybe not precisely right, but approximately right about values, and being very disciplined in when we bought them so that we had a margin of safety. And if you look at our returns, you know, everybody these returns look great. What's really impressive is the risk-adjusted returns, and that's what we're most proud of. And we're executing what Graham and Dodd, what Warren Buffett, what you're learning, what you have the opportunity to learn. We're just executing it. It does work if you execute it. Now, I want to shift gears for a second, and I'm going to stop and kind of pause and ask for questions. You can ask anything out of the blue. It could be, doesn't matter what it is. But I want to give you a couple examples. Like I was kind of harsh on beta, and I was kind of harsh on CAPM. I'm going to continue to be. This is a clip from a recent article in Barron's. By the way, some practical advice for all you guys while I'm thinking about it. Read Barron's. If you don't read it, start. Read the Wall Street Journal. At the very least, read the headlines on the front page. And if you can, read it all. You'll get an incredible perspective, and you'll kind of see how things really work, and it will be very helpful to you. There are publications like Value Investor Insight, where they interview people like me, and they interview people like Alan. And there's also a publication called Outstanding Investor Digest, which is published very infrequently, but Value Investor Insight is purchased pretty frequently. It costs money. I don't know what the subscription costs, but you know, consider it part of your education and read that. You will learn more about value investing, and you will see practitioners talk about real things. It's kind of like a peer-to-peer kind of thing. It's a lot better than a lot of other business publications you can read. If you have an interest in this area, I really urge you to supplement what you're doing with those publications. So this is from Barron's. People who hurry to disaster sites need to know when a rescue effort becomes a recovery operation. That's likely the case for investors in Super Value, the grocery retailer whose shares were cited here as an attractive speculative buy 4 months ago at more than twice their current price. The argument at the time was that Super Value's depressed stock price, then at $5.54, and a 6% plus dividend yield already accounted for its lousy sales trends and daunting competitive struggle. This has proven wrong. The dividend has been eliminated, the CEO displaced, and the company is inviting offers for all or part of itself. The market's current determination, with the stock price at $238 and its corporate bonds yielding around 9%, is that there might not be enough value to go around to cover the $6.1 billion of net debt, fund its pension obligations, and leave much of anything for equity holders, if it came down to that. where do I start with this? Okay, Barron's, a very good publication, wrote an article about 4 months ago, and they admitted they blew it. So good for them for that. And they were saying that this company might be cheap. It might be a value. I remember reading that article. I remember laughing at it. And this gets back into the execution of value investing. I just read this. Does anything jump out at anybody? Is there anything that I read, like the bond yields, the dividend yield, is there anything, the stock price, just anything at all that jumps out? Sure.
All the debt they had?
Well said, absolutely. Okay, so $6.2 billion of debt. What did Modigliani and Miller say? Shane? In a perfect world, capital structure is irrelevant. Right. So this company, could this company go bankrupt if it didn't have any debt? No, it couldn't. So if you're an equity holder and you're facing a situation like this and you have a lot of debt, what's your discount rate?
The required return on the stock?
Sure. What's the required return on the stock when you have that much debt?
Pretty high.
Yeah, real high. What did Modigliani and Miller say about that? Capital structures are irrelevant. It doesn't matter. It's just all reflected in beta, right? Beta just adjust it. Well, what do you think the beta is for a super value? Anybody hazard a guess?
1.5.
1.5. Okay, good. Anybody else? 1.18. Almost equal to the market. Beta would tell you that's not very risky. Fundamental analysis would tell you it is really risky. And I don't know what the discount rate is for equity, but I can tell you what, it's so high I wouldn't play. And that should be your answer. That's separating theoretical academic risk for real risk. And as a value investor, you want to be focused on the real risks. So, we would call super value in our shop a value trap. We want to avoid those like the plague. And that's where you get down to the execution of value investing. Value investing works really, really well when it is well executed. But you can't be superficial about it. You can't just say, oh, it's got a low PE, or oh, it's got a high dividend. Those are dangerous things. But notice, one of the core tenets, capital structure doesn't matter. And that discount rates, don't vary with capital structure. Well, it's not linear. Risk is not linear. And when you start getting into a situation where there's a possibility that you could lose permanent capital, that you're not just going to have volatility bouncing around, but because of the debt, your equity could be wiped out, the discount rate ramps up. It becomes a parabola. It's not linear. So that is another example of where the real world meets the theory. Is anybody familiar with AIG? That company, the federal government almost went bankrupt. The federal government bailed them out because they thought they were, important to the financial system. AIG looked kind of cheap back in 2007, going into 2008. AIG has an incredibly complex balance sheet. Really difficult to figure out what was really going on there. During the financial crisis, when that thing was melting down, it was a company that we just avoided, kind of like this. We just said, this is a value trap. We're not even going to think about it. Other value investors bought it. Some did. They got destroyed. Going into 2008, would anybody hazard to guess what? So obviously, look, in hindsight, there was a lot of risk there, right? I mean, the company almost went bankrupt. It was almost a zero. So you would have lost virtually 100% of your investment. Does anybody have an idea what the beta of AIG might have been at that time? Just a wild guess, anybody?
Probably less than 1, 0.8.
Good answer. Anybody else? It was 1.2. Just happened to be about the same super values. I don't know why I kept finding these things, but it was about 1.2, very close to the market, right before it was about to blow up. If you were doing your homework and you looked at their balance sheet, you would say this thing is toxic, it's highly leveraged, there's a lot of risk here, an awful lot of risk, just like there's risk in super value because of all its balance sheet risk. But beta would have told you no, it's not risky at all, or just moderately more risky than the market. Now today, the government has implicitly backed the company and basically said we're not going to let this thing go bankrupt no matter what. So basically, with a backstop from the government, how risky do you think AIG is today? Which actually is getting more risky by the day, right? But leaving that aside, not that risky because the government has said we're not going to let this thing fail. And so we still a crummy business and we'd have no interest in owning it. But it's a lot less risky today. What do you think the beta is for this company today? 1.1. I'm sorry? 1.1. All right, it's a good valid answer. Anybody else? 1.8. 1.8. Get this. 3.42. So you see the framework is really good, and you can use that framework as part of your toolkit, but you have really got to understand what is real risk and what is theoretical risk. Because if you get caught up in theoretical risk and you run everything that way, you're going to be the CFOs who are locking your shareholders into 2% bond yields and destroying value. You're going to lead the next AIG. You're gonna destroy a bunch of people with Facebook. Or you could be the next Warren Buffett. You could be the next Bill Ruane. You could be the next John Templeton. Study the margin of safety. Study risk. Understand risk. Forget about returns. Understand risk and understand what real risk is and understand what Graham and Dodd were talking about when they talked about the margin of safety. If you can do that and you can marry that with the academic toolkit that you're going to get, which is very, very good, you will be incredibly successful. You will absolutely execute the value investing philosophy. Now, we're sitting here in this wonderful institution, and I'm kind of inspired by being here, and I'm inspired by you being here and what y'all have accomplished. But here we are on hallowed ground where Bear Bryant walked around. The Hall of Champions. I'm kind of getting goosebumps. And so a lot of people say, oh, well, it's just random noise. It's just luck. It's just luck. It's just throwing darts at a dartboard. Well, remember what I said about risk and getting that part right and understanding that? And all the literature is out there. You can read it. If you're not lazy, if we just learn it, it's all out there. And use the academic toolkit you get, marry it with this wisdom that has been passed down since the 1930s. And you know what? It's not just luck. As Bear Bryant said, you make your own luck. You make your own luck. That's all I have to say. Unless there are questions.